Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in TradFi, digital assets, technology, and financial planning. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site is Ryan McCormack, Factor and Core Equity Strategist with Invesco, Mark Marex, Director of Index Research and Development with Nasdaq Investment Intelligence, John Jacobs, former Nasdaq Executive Vice President and Chief Marketing Officer, and we have David Berdon, Managing Director with Morgan Stanley Private Wealth Management. They join me to discuss the history of the QQQ ETF, current performance and trends of the Nasdaq-100 Index, what makes the fund unique, and how advisors are using it in their portfolios. Gentlemen, it's great to have you with us. Welcome to Trade Talks and welcome to MarketSite. John, I'm going to kick it off with you. You have a long history with Nasdaq, and particularly the QQQ ETF. What was your role in the ideation of the product?
So I was running strategic planning for Nasdaq back in the late 90s. And one of the things we're looking at is we're building, Nasdaq today is the largest exchange company in the world, complex in the world. It wasn't that way back then. And so what we did was we had a multi-pronged approach, and one of the things we wanted to do was put investment and trading products in the hands of investors that were Nasdaq branded. So you don't have to pick a Nasdaq stock, you could pick a basket of Nasdaq stocks. So it's ETFs, funds, options, futures, et cetera. So that was the idea behind it originally, was to build out the Nasdaq value proposition for investors and traders.
And Mark, when we look back at the Nasdaq 100 25 years ago, how have you seen it evolve and how it represented in today's marketplace?
Yeah, I think the evolution has been extraordinary. If you look at sort of the percentage of US market cap that the Nasdaq 100 represented in those early years, in the early 2000s, it was 10, 15% maybe, depending on whether you're looking at, tech bubble or post-tech bubble. Nowadays, it's grown to be about 50%. So something like the S&P 500, about half of that market cap comes from Nasdaq 100 companies. So, the way we look at it is it's no longer this sort of niche kind of potential satellite holding that could be in an investor's portfolio. It's really kind of earned its place as a core option for investors looking to get meaningful large cap growth exposure.
And it's interesting because, to your point, with the S&P 500 as an example, you've seen how the sectors have evolved, lending to the higher weighting within the technology space. So explain to us how the Nasdaq 100 is calculated and how do companies enter and exit the index?
Yeah, sure. I mean, it's a pretty detailed methodology for anyone who's a sort of index methodology nerd. I encourage everyone to read it. There's a lot of nuance in there in terms of how we weight and make sure that there's not too much concentration in the index, for example. We do quarterly weight adjustments, annual weight adjustments at the constituent level, and also kind of looking at groups of companies that potentially get too big. So it's very, very detailed. It's obviously super transparent, rules-based, and it's mostly driven by that market cap ranking on the Nasdaq exchange. If you are among those 100 largest companies listed on the exchange, ex-financials, right? So never any banks, insurance, brokerage companies, ex-financials, you'll make it into the index, and we reconstitute once a year in December. That's your best shot at getting into the index.
And Ryan, if you could describe the Qs in 3 words, what would they be and why?
Normally I have to describe them in way more than 3 words, so distilling it down is going to be tough. I think maybe first would be groundbreaking. One of the first ETFs listed here in the US. I mean, having a 25th anniversary is something that not many ETFs can boast about. So I think that probably will start at the beginning. Next, I think would be innovative, right? We talk about how, in those early days, that was sort of the birth of the ETF ecosystem, and we look over the last 25 years, that ecosystem looks a lot different today than it did back in 1999. I think beyond that, you look at the underlying constituents and where performance comes from. We think a big part of that is being driven by companies' commitment to research and development. So we look at companies that are spending more than, on average, other competing indices, say the S&P 500, the Russell 1000 growth. And that commitment in research and development, I think, has allowed a lot of these companies to remain pretty agile, pretty nimble. Even they look very different today than they did 5, 10, 15 years ago. And I think that's been the hallmark and certainly the driver of that performance, and subsequently the performance of QQQ. So innovative would be my second word. And then third, let's say popular. QQQ is the 5th largest ETF in the US. It's, depending on the day that you look, around $250 billion in assets. It's the 2nd most actively traded in terms of average daily value traded. So I think popular, I mean, we see a a lot of different investors using it. I think, ETFs, you hear people talk about it being the democratization of investing, allowing access to strategies that previously probably wasn't accessible by the retail investor. But we see use by retail investors, we see use by home offices, financial advisors, institutional clients. I think it's just widely known and popular, and I think that's it's something to be said about the use cases that we've seen in the past 25 years and the types of investors we see that own it.
So David, let's talk about this more. How are advisors using it within their strategies to support their investors' goals?
So look, large cap US equities are the most efficient market in the world. And for the most part, active management just doesn't work. It's not my opinion, that's a fact. What are the numbers? Over the last 5 years, 7% of large cap growth managers beat their benchmark. If you want to extend the time, over the last 10 years, only 5% beat their benchmark. So if you're using active management in large cap US equities, it's a strategy based on hope. In my opinion, with my clients, I do not want to go to my clients with a strategy based on, I hope I picked the right manager. I want a strategy that outperforms or performs really well. The Qs come from Invesco. They are the leader in the business. And you just look at the track record. The Qs give us exposure to what has been and might continue to be the best part of the US equity markets.
Right, and John, this is a perfect segue to my next
Absolutely.
question. Why partner with Invesco for the QQQ?
So we had started the Qs off internally as a fund company within Nasdaq, and we realized quickly we don't want to be an asset manager. We're an indexer, data company, exchange, and all that. So we looked around for a good partner, and PowerShares was merging into Invesco. And when we talked to the team at Invesco, they said, we have 400 salespeople. Nasdaq had 3. It was easy math to figure out that we would be able to broaden the distribution. I think Qs put, as you mentioned, Qs put ETFs on the map for retail investors. There wasn't and put Nasdaq on the map for retail investors. And I think Invesco just took it to the next level by far with institutions and across the board. So that was the partnership. They do what they do far better than we do, and we do what we do, and it's a great partnership.
It's interesting. Ryan had said one of the 3 key words, his last one was popular, and that resonated with me because the first thing I think of when I see the Qs are NCAA sports, right? We're all familiar with the commercials. So as a prior chief marketing officer at Nasdaq, what excited you about the first marketing campaign for Invesco QQQ? What did that look like?
So the first campaigns for the Qs was actually a very simple message. It was, don't know which Nasdaq stock to buy the basket. That's what it was, because there are all these great names, and you can talk about them today. They're great names back then, some of them are still the same, or the great names today. So why pick one? You can pick the basket. And so, and then you're trying to figure out where to reach those people. Sports and financial services is a great overlap and always has been. So there's been a long history of tennis and all sorts of other sports and NCAA. And believe me, I'm thrilled when I look at the NCAA tournament, watching my Maryland Terrapins somewhere, and trying to see the Qs. But it's a great overlap.
Yeah, it certainly is. Let's talk about some trends here and some market conversation. Mark, what trends for the remainder of 2024, what is in store for the Nasdaq-100?
Yeah, great question, Jill. I mean, I think to answer that, you really got to look at what's happened over the last few years in the Nasdaq-100 and in the broader market. Of course, we had in 2020 that short, nasty COVID bear market where the Nasdaq-100 actually outperformed the broader benchmarks in the US on the way down and led that recovery on the way up. Seeing a lot of that demand pulled forward for things like, Apple's phones and computers, to e-commerce, cloud computing. That really drove a sharp leg up in the index in 2020 and 2021. We then had, the inflation scare in 2022. The index took a big step back as people started to get concerned about, the impact of higher rates on growth, not just in terms of fundamental growth, but the valuations, right? And then, of course, last year, generative AI was the story in terms of this massive new secular growth driver for a lot of the names in the index, everyone from NVIDIA, right, in terms of designing those chips and really owning the market for the most sophisticated GPUs, to all the hyperscalers, right? Amazon with AWS, Microsoft with Azure, Google with its cloud platform. There's just a tremendous amount of opportunity for the names at the top. I think everyone kind of understands that at this point, looking at the performance last year. I think what people are waiting to see throughout this year is to see how that leadership filters down into some of the smaller names in the index, names like maybe AMD, who can come into that second place rotation after NVIDIA for those GPUs. Names in the pure software space, in the kind of more software services space that are going to be adding value for years to come. That story is still panning out, and it's going to be very interesting to see again how that leadership, I think, filters down into the rest of the index.
Right, and Ryan, what were some surprises for you in terms of performance? And then, of course, what are some of your thoughts around the macro and how it's impacting the Qs?
Yeah, I think Mark makes a really good point. That's something that we're all looking for, right? Like, who's going to be, in the jockeying for position, right? Is it a Broadcom? Is it maybe kind of an older, how quickly can Intel kind of reshape what they're trying to do in their offerings? Or is it somebody like a Marvell Tech, or, who kind of comes in behind NVIDIA at this point? So I think that's really interesting. And obviously, all the focus has been on generative AI and certainly the semiconductor space. But, a name like Netflix, I think will surprise a lot of people. Performed really, really well. I mean, for some time was certainly in the media's eyes a darling. I mean, FANG.
We used to have FANG.
There you go, right?
7,
now
right?
it's Mag 7.
It's going to be some different.
And you had brought up the Elite 8, right? We're in March.
Right. Broadcom easily can be part of that Elite 8 too.
And a perfect example, though, is look at Netflix model themselves 25 years ago to today. Mailing out DVDs to content, it's just so the companies do change.
NVIDIA as well.
NVIDIA as well, absolutely.
I mean, I think all the successful companies at the top. I mean, the one that I always joke about is Amazon.
Right.
I mean, Amazon, and I tell this joke everywhere. Like, people forget Amazon was trying to put Barnes and Noble out of business.
Absolutely.
Right. That's where they rose to prominence, and now they're arguably the world's largest provider of cloud services. That looks very different than an online book retailer.
Absolutely.
And the list goes on. So I do think it's really funny. And I remember Netflix, right, when they said we're discontinuing the DVD, the uproar. Oh, how could you, right?
Look, we've all seen this analysis. You go back 20 years, what were the top 10 companies?
Right.
Fast forward, almost all in any running period, it's a whole new group of companies. So what this gives us exposure to is that elite group of companies. We don't have to do the work ourselves. We just buy the Qs.
Right, and a great point you made earlier, Mark, about how it's a transparent, rules-based index. That means investors pick every year the winners. Investors pick who's in it. Investors pick who's the biggest stocks and down and so on. It's your job just to administer, but investors vote, and that's the beauty of that index, I think.
But one thing I will add to that, I think, is in terms of what makes the index special, in terms of how we try to explain the outperformance that happens almost every year. I think it's something like 12 out of the last 16 years we've beat the S&P 500. The innovation focus is a huge part of that story, right? What drives growth in the 21st century?
Sure.
Innovation drives growth drives fundamentals, fundamentals ultimately drive performance. It's really that Nasdaq exchange part of the methodology where if you're not Nasdaq listed, you're not going to make it into the index. That to me is what makes it most special. I feel like it's developed over the decades to be this great signaling mechanism that companies make to their investors in the broader market. Hey, we want to be innovation focused. We want to be forward thinking. We want to list on the Nasdaq exchange and hopefully make it into the Nasdaq-100 someday. That to me is what makes it special, what helps explain sort of its success.
And well, look at some of the switches that we've had come to Nasdaq, right?
Absolutely.
That are, considered Honeywell as an example, right? You would think of that as an industrial company, but across the board, regardless of what sector you're in, technology has to be a core part of the story.
And I think even from the nexus of it, right, being the first electronic exchange, I mean, that alone kind of, you look at sort of the technologically oriented company that gravitated towards NASDAQ. And I think, certainly as we've progressed, I mean, that's persisted, right? Do you hear names like Apple or a Microsoft or an Amazon? I mean, as a young or up and coming company, is that who you want to be? Absolutely.
New companies IPOing, there's only one option.
Right.
Right.
So Ryan, if you were to say given a choice for a fourth word, I would say category defining, because to me, the companies in the NASDAQ are category defining. NASDAQ itself is category defining, and the Qs are category defining. They really do represent ETFs in the hands of investors more than most products out there. So category defining would have been my fourth choice for an adjective to describe it.
And so, David, when you're leveraging the QQQs within a portfolio, is it a core holding or a supplement to existing positions?
Right. So it really depends on the client. Everything we do is bottoms up. So we get to know the client, we understand their goals around risk, returns, liquidity, and then it's a bottom up build. It's a little bit different than most people think about how portfolios are constructed, but asset allocation is almost, for us, the output, not the input, because it's truly bottoms up. What income do we need? What growth do we need? Taking everything a client's looking for into account. The Qs play an essential role because it gives an exposure to such an important, such a successful part of the market. So you really need to include the Qs, but it's hard to generalize from one client versus another because it's all about their needs and goals.
Yeah, but back to what you were saying before with Netflix, and we were saying, no more mailing in the DVDs anymore. But there's so many definable moments within the companies that make up the QQQ. Yes. I remember when Apple launched the iPad, my first thing was, this is going to transform healthcare. We could look at MRIs, sonograms instantly on something that is shareable and readable instantaneously. You can remember those days when products were launched.
Yeah, absolutely.
It's hard to find a seminal event or tech trend or something big going on in the world today that is not covered on the Nasdaq.
Right, yeah, that's a good point. So when we think about the next 25 years, or even more near term than that, and Mark, you could speak to us in terms of index innovation, and we'll get to, in terms of the innovation that we're seeing at Invesco, because that really is the core word here is innovation. What are your thoughts? How does the index industry continue to innovate?
Yeah, I mean, it's a great question. Look, we've worked with Invesco, I think, pretty successfully over the last few years to, among other things, build out that innovation suite, right, with the Nasdaq-100 as your sort of large cap anchor. We've built out, mid cap, small cap extensions of that. We've tried to get creative around using, newish types of factors to inform the way that some of those companies get selected for inclusion in some of those other indexes. I think it's a really, really special time to be in indexing because, as David was mentioning, I think people are finally getting the message that active management, maybe not for everything, but for a lot of things, for a big chunk of investors' portfolios, has just demonstrated that it's not able to consistently deliver that value add, all the extra effort and fees that go into active management for something like large cap US or large cap growth. It's hard to justify that over the long term, and so there's this huge momentum in terms of getting assets to move over into passive and especially into ETFs, and it's allowing a company like Nasdaq with a very stable core of its index business with the Qs to get creative. What other problems can we solve for investors where they're not getting the types of outcomes that they want from active management? How can you build a multi-factor strategy in a passive, rules-based, transparent index? We're thinking about that stuff every single day, and we're looking to do it domestic, international, old factors, new factors. It's a great time to be there.
And Ryan, from Invesco's perspective.
Yeah, no, I think Mark hit the nail on the head. He and I talk multiple times every week. I mean, we're thinking about Nasdaq-listed companies and ways that we can capitalize on new factors, exciting ways to bring access to innovators. And Mark hit the nail on the head. We started it with sort of the extension of the innovation suite. So we look down cap with QQQJ, capturing more the mid cap angle, QQQS using patents as an indicator of maybe underappreciated value in the market, ESG versions of popular indices for those that may want that option. But it's a time that continues to grow. I mean, Nasdaq is one of our most important partners. We have over 80 different ETFs, representing close to $300 billion in assets. I mean, we are finding new ways to give access to investors in this marketplace, and it really is an exciting time.
All right, gentlemen, we appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.